You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
Okay, we are back. Very happy to have on the show with us today Zane Brown, who's a partner and fixed income strategist with Lord Abbett. Zane, a pleasure to have you.
Thank you. Pleasure to be with you. Thank you, Doug.
We actually first met about a year ago at a conference in Chicago, and you spoke a lot about the fixed income market, and specifically a topic that came up was about inflation. Since then, a lot has happened, and I'm curious what your take is on inflation now.
Oh, well, certainly with all the global easing that we've seen from central banks, not only here in the United States, but in Japan and in the UK and the ECB, that certainly has created a lot of concern about inflation, all this excess money that's been created. I think, though, that much of that money hasn't yet been put to work, but it is kind of a cloud on the horizon. So although we don't expect inflation this year or next year, it certainly seems like it's poised to unfold at some time. And this open-ended aspect of QE3 that the Fed has just recently embraced, I think causes even more concern among a lot of investors.
In order to have inflation, don't you need some sort of heating up of the economy, not just printing money?
Well, that's true, and that's why I say that there's a lot of money, but it hasn't yet been put to work. So it really exists in a big blob out there at banks as unused reserves. Now, in the United States, banks are starting to put that money to work. We've seen an increase in commercial and industrial loans, and finally we've seen an increase not only in mortgages, but in personal loans as well. So those are growing at about a 5 to 8% rate. And so finally, banks are starting to put that money to work. And yes, we don't have kind of economic growth to the tune of 3 or 4%, but I think a lot of people are fearful that even once we get above 2.5%, it could start to stoke inflation. And certainly we have fears of inflation even now. We've got a lot of investors calling up and asking, what alternatives do you have that I can put in my portfolio today in case we get inflation sometime in the future?
When we talk about inflation, what would be a normal level of inflation to expect?
Well, certainly the Fed would like to target 2%. Historically, we've had a little bit more than 2%. Most recently, in the United States, it's been down to 1.7%.
And going forward, because you talk about a lot of inflation, it makes guys like me who are financial planners is my day job. I only do the radio thing once a week. But I talk about inflation, and certainly the comments you've made make us feel that maybe you're talking about very extreme inflation.
No, actually, I think even a little bit of inflation erodes the value of your investments and your portfolio over time. And I think that people are so concerned that we've had below 2% inflation for a while that if it bumps up to 2.5% to 3%, that they even want to protect themselves against that. The real concern, though, is that with money growing so rapidly in the United States and elsewhere in the world, that even if the Fed does do a good job of managing inflation here, it may get out of control elsewhere in the world. And I think there is an underlying fear that this opportunity for really severe inflation of 5% or more will exist somewhere in the world, and that's likely to compromise part of their portfolio. So we don't really project that this year in 2012 or even in 2013, but more and more people are saying, boy, I just think at some point this is going to come back and hurt me, and therefore I want to own something that's going to do well in that environment.
In talking about the increase of the amount of money, certainly one of the discussions is the U.S. debt, which is so huge that the easiest way for them to pay it off is simply to turn on the printing presses at full speed. Is that really what will be happening, or what is happening?
I guess there is the fear that the way for us to resolve the deficits that we have will be to inflate our way out. And there have been periods in our history and in other countries throughout the world where governments have inflated their way out, meaning that they allow inflation to continue to grow, and therefore they pay back their debts in subsequently cheaper currency. In our case, it would be cheaper dollars. So I don't think that's really what we're talking about, but certainly there is that fear out there, and that fear has driven investment behavior.
The number that we use for inflation, normally we just talk about the CPI. Is this a politically manipulated figure?
I laugh because a lot of people will say it's manipulated and it's unfair, because the most important inflation indication in the United States is core PCE deflator, and that's core personal consumption expenditures deflator. And core eliminates energy, and it eliminates food and fuel. And a lot of individuals are saying, wait a minute, why are you doing that? That's the biggest part of my budget, and that's what's really increasing. And so a lot of people would suggest that it is not necessarily manipulated, but the benchmark that they use is unfair. But the reason they use that is because food and fuel really add a great deal of volatility, so the Fed instead focuses on core. Over long periods of time, it actually is a fair measure, and it just eliminates some of the volatility. But the underlying concern is that at some point it's going to go well beyond 2%, and that would hurt at least a lot of fixed income assets that seem to dominate many portfolios today.
Okay. We are talking with Zane Brown, who's a partner and fixed income strategist with Lord Abbett. He's been talking to us about the inflation going on. We've been focusing on the U.S. You mentioned this concept of the core inflation figure. So let's say that you're an individual investor and you want to protect your buying power. You're a 50-year-old guy and you want to protect your buying power into and through much of your retirement. If the figures that are being used to calculate, for example, the inflation on TIPS, Treasury Inflation Protected Securities, is based on a number that doesn't include energy and food, how can a guy like that really protect himself?
Well, I guess the real problem also with TIPS is that you don't get paid a great deal right now. Yeah. I mean, the coupon is 1/8 of 1% on most of the TIPS that have maturities less than 10 years. And actually the price is 106 or 109, meaning you're paying a premium above the maturity value of 100. And that really translates into a negative yield. So you're buying this negative yield with almost the hope that you get higher inflation. So you end up with, an adjustment to your investment. So I think there are some difficulties with TIPS right now. And there are some other alternatives that people have been looking at that probably serve them much better than this government mechanism that was designed to address fears of inflation.
Okay, so I do want to ask you what the other solutions are, but before we do, I want to touch on this point. If the government originally marketed the TIPS that they were offering as a way to help people to protect themselves against inflation, would you say that at this stage it simply is not working that way?
Well, I would say that at this stage, it's probably not working all that well because of the low rate of return that you get on all government investments, and actually now the negative rate of return that you get on TIPS or Treasury Inflation Protected Securities. So it probably wasn't really designed to help the investor. It was more designed as an alternative way for the government to raise money whenever there was a high inflationary environment, and they thought this was a way to diversify the government's portfolio of debt that they offered different people. So I'm not sure that it had the ultimate investor's best interests in mind.
So if there's a concern that there will in fact be inflation, do you think the government might slow down their offering of TIPS and go back to more fixed coupon securities?
I really haven't seen the government kind of manipulate their offerings along those lines. I would think that if there was a pickup in inflation and there was more interest, that the government would be very happy to satisfy that interest and raise money in the TIPS vehicle, just take advantage of interest wherever they can find it and raise money wherever it is most likely easiest for them to do that.
Okay, so now let's focus on the other question, which is,
Sure.
if tips are not such a great hedge against inflation these days, what are the tools that are available to normal people?
Well, a lot of people have focused on gold, and gold includes a number of other influences. Certainly there's a fear factor that drives the price of gold higher. There's a jewelry factor that drives the price of gold higher. So it's not just about inflation. And then there are things like CPI swaps, where you basically, an institution can enter into an agreement where if there's an increase in CPI, and this time you can use whole CPI that includes food and energy, and if you find an increase in that, then the value of your future payments then increases. And sometimes those CPI swaps are incorporated in mutual funds that individual investors can buy. Lord Abbett has one of those. It's called an inflation focus fund, and it does use those institutional CPI swaps on behalf of individual investors, so that if there is a big increase in headline CPI that includes food and fuel, that the value of the investment increases accordingly.
Okay, so they're rather sophisticated investments, these swaps. In fact, many people blame not these specific swaps, but other types of swaps for the demise of the market a few years ago. These, I presume, are something very different?
Well, yes, they are different. I mean, we aren't trying to speculate. We are trying to protect. And I think that, any vehicle that you have in finance, you can use it in an appropriate manner, or you can somehow manipulate it in an inappropriate manner. And I think derivative securities of all kinds really got a bad name in this most recent downturn a few years ago as contributing to the level of volatility and the level of leverage that exists in a lot of institutional portfolios. Here, we're really trying to protect an investor for a rise in inflation. And if you don't get the rise in inflation, it's not that it has huge downside risk. And I think therein lies the difference between between this kind of approach and using sophisticated instruments like this to add leverage and make huge bets. That's not what we're doing here.
So it's something that an individual investor could buy to protect himself if there's inflation. And if it turns out that there's not inflation or deflation, then the downside, you're saying, is not quite so severe?
Exactly. And in fact, we've seen that this year. I mean, we've seen that inflation hasn't gone up this year. It's actually gone down. And the individual investors who got involved in this inflation-focused fund at the beginning of the year, because the design of the fund protects against inflation and invests in other vehicles that gives them a decent return. They've had a great return through, say, the first 9 months of this year. It's between 7 and 3. It's about 7.75%. So that's a pretty attractive return while you had protection against inflation. And then, like you pointed out, what we really had was the CPI in January going from something like 2.9% down now to 1.7%. So there's an example of inflation not going in the direction you wanted, but you still had an attractive return.
Okay, let's just be sure to mention that past performance is no guarantee of future returns, and that all mutual funds are sold by prospectus, so that people who are looking to invest in this or any other fund should certainly read up on it before they send money. We've been speaking to Zane Brown, who's a partner and a fixed income strategist at Lord Abbett. Zane, we're really just about out of time, but first of all, I want to thank you very much for your thoughts and ask, how can people follow the work that you're doing?
Well, certainly we can log on to our website, LordAbbett.com. I publish articles frequently on inflation, on different developments in fixed income markets. This has been unusual. We usually don't talk about a specific product, but I think the conversation led us to it this time. But there are specific products that are discussed on LordAbbett.com, and then there are general conversations about what's going on in the global economy, what's going on in interest rates, and where there might be value in other kinds of investments as well.
Okay, Zane Brown from Lord Abbett, thanks so much for your time.
You bet. Thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.